Ladies and gentlemen, you have been connected for Mankind Pharma Limited conference call. Please stay connected. The call will begin at 6:15. Ladies and gentlemen, you have been connected for Mankind Pharma Limited conference call. Please stay connected. The call will begin at 6:15. Ladies and gentlemen, you have been connected for Mankind Pharma Limited conference call. Please stay connected. The call will begin at 6:15. Ladies and gentlemen, you have been connected for Mankind Pharma Limited conference call. Please stay connected. We will begin at 6:15. Ladies and gentlemen, you have been connected for Mankind Pharma Limited conference call. Please stay connected. The conference will begin at 6:15. Ladies and gentlemen, you have been connected for Mankind Pharma Limited conference call. Please stay connected. The call will begin at 6:15. Ladies and gentlemen, good day and welcome to the Mankind Pharma Limited Q4 and FY25 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Abhishek Agarwal, Head Investor Relations and AVP Strategies of Mankind Pharma. Thank you, and over to you, sir.
Good evening and very warm welcome to our fourth quarter and full year FY25 earnings call. Firstly, apologies for delayed start. On the call today we have Mr. Rajeev Juneja, our Vice Chairman and Managing Director, Mr. Arora, Chief Executive Officer and Whole-Time Director, Mr. Arjun Juneja, Chief Operating Officer, Mr. Sudipto Roy, Senior President, Sales and Marketing, Mr. Ashutosh Dhawan, Group CFO, Mr. Prakash Agarwal, President Strategy. We will begin today's call with Mr. Rajeev Juneja, who will provide an overview of our performance for the quarter gone by, followed by Mr. Arora providing an in-depth insight for business performance and outlook. Mr. Ashutosh Dhawan will then share the financial highlights, after which we will open the session for our questions. Please note today's discussion includes certain forward-looking statements reflecting management expectations for future performance of the company, and these estimates involve several risks and uncertainties, and actual results may vary. Mankind does not undertake any obligation to publicly update any forward-looking statement, whether as a result of new information, future events, or otherwise. For a detailed disclaimer, please refer to our investor presentation uploaded on our website. Now I will hand it over to Rajeev sir for his comments.
Thank you, Abhishek. Good evening and welcome to our quarter 4 and year 25 earnings call. As we celebrate 30 years of operation, we look back on our purpose-driven journey that has redefined high-quality healthcare, accessible across Bharat.
Sorry to interrupt. Can you please shift the mic towards yourself?
Okay. Thank you, Abhishek. A very good evening and welcome to our quarter 4 and year 25 earnings call. As we celebrate 30 years of operations, we look back on our purpose-driven journey that has redefined high-quality healthcare accessible across Bharat at affordable prices, especially in the regions that have long remained underserved. Over the years, Mankind has consistently expanded its presence and leadership with a strong foundation in mass market, acute and semi-chronic therapies, specialty, chronic and consumer healthcare segments. Today, we are honored to be recognized as 4th largest pharmaceutical company in India by value and the 2nd largest by volume in IPM. This achievement underscores the impact we have created and the trust we have earned over the years. Our recent acquisition of BSV marks a significant step forward, enhancing our presence in super specialty segments. Following that acquisition, we have undertaken strategic initiatives, including the integration of BSV's prescription business into Mankind's platform for long-term sustainable growth. This has been a transformative year at Mankind with several initiatives focused on enhancing doctors' engagement, digitizing of operations, workforce upskills, and optimizing policies and processes for next leg of growth across therapies. Moving ahead with our quarterly performance, in quarter 4 25, our revenue increased to 3,079 crore, registering a growth of 27% year-on-year and adjusted EBITDA margin of 23.1%. For year 25, our revenue increased by 19% year-on-year with an adjusted EBITDA margin of around 26%. In quarter 4 25, our revenue from domestic business grew by 18% year-on-year, majorly driven by chronic outperformance and consolidation of BSV business. Our chronic share excluding BSV, increased to 39.2% in Q4 25 as compared to 37.5% in Q4 last year, driven by an outperformance of 1.3 times to IPM growth. Further, our recent launch of empagliflozin anti-diabetes witnessed strong traction, gaining more than 8% volume market share in March 25 and ranked among top 3 launches. Mankind PCPM has also increased to 6.8 lakh rupees in this year 25 from 6.5 last year. As far as OTC is concerned, this year has marked a progressive shift in consumer healthcare business as the benefits of our prior strategic initiatives begin to materialize from second quarter onwards, driving strong growth, showcasing the strength of our brands and our agile execution. In Q4 25, consumer healthcare revenue stood at 178 crore rupees, growing at 14% year-on-year. Revenue for 25 also increased by 15% to 809 crore rupees. We achieved a strong 77% year-on-year growth in modern trade and e-commerce channels, further enhancing market share of our key brands. Our recently launched products have also witnessed robust growth across brands, including Nemo Lids, Ova News. Even our Manforce Epic Thin X condom gained strong traction in its first year of launch. As part of our continued innovation in R&D, we have made notable strides in our R&D efforts with our new NCE molecule GPR119 targeting obesity, diabetes, and metabolic disorders have advanced to phase 2 clinical trials. In parallel, we are actively exploring strategic partnerships for GLP-1 that would enable us to launch the product post-patent expiry, which is anticipated next year. The year gone by, we have laid a strong foundation to deliver long-term sustainable growth led by our 4 key pillars. Number 1, steady base business. Second, fast-growing specialty chronic. Third, high potential OTC business. And fourth is high entry barrier super specialty portfolio of BSV. I would now like to invite Chetan to share further insights into our business performance.
Hello everyone. A very good evening to all. We truly appreciate your presence as we share our Q4 and financial year 25 performance. With dedicated focus and consistent performance, we have emerged as a leading player in the Indian pharmaceutical market, ranked number 1 in prescription for 8 consecutive years. Today, our prescription shares stand at 15.5% with 84.1% prescriber penetration, a reflection of the long-standing trust and credibility we have built within the medical community. While our growth has largely been organic, in recent years, we have strategically pursued select inorganic opportunities to address identified white spaces, particularly in the specialty chronic segment. Through in-licensing partnerships with global pharma leaders, we have introduced niche and complex products like Neptas, Nobiglar, Symbicort, and Crenzlo, boosting our offerings in the specialty chronic category. We have further deepened our specialty presence through acquisitions such as Panacea Oncology and Transplant business, and select brands like Combihale and Daffy. Additionally, our recent acquisition of BSV has resulted in a rise in our overall value market share in IPM to 4.8% and our volume share to 6%. This acquisition has also firmly positioned us as leaders in the gynecology segment with a 10.54% market share. Its women's health portfolio presents new avenue for growth, allowing us to expand across both established and emerging markets. We are confident in leveraging these opportunities to establish ourselves as the most trusted brand in women's health. Let us now move to a summary of our business performance. If I talk about domestic business, in quarter 4 of financial year 25, our domestic revenue increased 18% year-on-year, driven by a strong momentum in chronic therapies and contribution from the BSV portfolio. Our organic growth for the quarter was 10% year-on-year. For the full year financial year 25, domestic revenue crossed the 10,000 crore milestone, reaching 10,675 crore, a 13% year-on-year growth. Our organic growth for the year is 9%. During the year, the number of brand families crossing the 50 crore revenue mark increased from 43 to 49, with notable additions including Glutaflame, Histafree, Uricane, and 3 brands from BSV. Our presence in metro and tier 1 cities grew from 53% to 56% in the financial year 25. Chronic therapy growth stood at 11%, compared to 8.7% growth in IPM chronic, an outperformance of 1.3 times in quarter 4 financial year 25. This growth was led by significant gains of 15.1% in cardiac and 9.4% in anti-diabetes segment, reflecting consistent outperformance of 1.5x and 1.3x respectively compared to the IPM. We have also expanded our DMF grade portfolio to over 250 products with a focus on the chronic segment. Now talking about the international business, revenue from the international business doubled to 535 crore in quarter 4 financial year 25, up from 267 crore in quarter 4 financial year 24. Organic growth in international markets was in the low single digits during the quarter. For the full year financial year 25, international revenue grew 88% to 1,532 crore, with organic growth of 37% year-on-year. This was supported by combination of base business momentum and one-off opportunities in the US for Mankind, and the successful integration of BSV. Looking ahead, we expect our domestic revenue growth to outperform IPM by around 1.2 times in financial year 26. We anticipate an increase in R&D investment to 2.5% to 3% of revenue in financial year 26, up from 2.1% in financial year 25. Accordingly, we expect EBITDA margin to be in the range of 25 to 26% in financial year 26. Our 30-year journey has been nothing short of transformative, marked by challenges, resilience, and progress. Yet at Mankind, we see this not as a destination, but a stepping stone to even a greater milestone. With the commitment of our team and the customer-centric approach at the core, we are determined to keep evolving, creating value, and improving life every step of the way. Now I invite Ashutosh to provide a detailed insight into the financial performance. Thank you so much.
Yes. Thanks, Chetan. A very warm welcome to everyone joining us for our Q4 FY25 performance discussion. Before we proceed with the financial performance, I would like to highlight that these Q4 FY25 financials are the first full quarter of BSV results, and FY25 includes 160 days of BSV financial performance. As committed, we have monetized our non-core asset, that is Mahananda Spa and Resorts Private Limited, consideration of rupees 562 crores on 11th of February 2025. Consequently, we have classified our financial performance into continuing and discontinued operations for this quarter, and corresponding prior periods have also been reclassified to give a true and fair view of our continuing operations. Accordingly, we will focus our discussion on the performance of continuing operations, and for the comprehensive view, we have included discontinued operations. Please refer to slide 31 of our Q4 FY25 earnings presentation. In Q4 FY25, our revenue from operations has increased by 27.1% year-on-year basis to rupees 3,079 crores as compared to rupees 2,422 crores in Q4 FY24. This is driven by growth in our base business and consolidation of BSV results. For FY25, our revenue has grown by 19% year-on-year basis to rupees 12,207 crores vis-a-vis rupees 10,260 crores in FY24. During the year, our gross margin have increased by 190 basis points to 71.6% from 69.7% in Q4 FY24. This increase is driven by combination of sales price increase effect as well as favorable sales mix. For the full year, our gross margins have increased by 260 basis points to 71.4% as compared to 68.8% in FY24. This is majorly on account of sales price increase effect, which has contributed 120 basis points, and the balance 140 basis points is the combination of better sales mix as our chronic contribution has increased by 150 basis points on year-on-year basis, as well as certain operational efficiencies have also been achieved in our manufacturing processes. During the quarter, our reported EBITDA has increased by 16.4% year-on-year to rupees 686 crores with a margin of 22.3% as compared to rupees 589 crores and a margin of 24.3% in Q4 FY24. Further, there has been some spillover of the integration costs related to BSV, which amounts to rupees 25 crores, and after adjusting the same, our adjusted EBITDA margin is 23.1% in Q4 FY25. This decline in adjusted EBITDA margin of 120 basis points year-on-year basis for the quarter was primarily due to increase in our selling and other expenses pursuant to launch of certain brands like Ampa and relaunch of certain RX brands of BSV. For FY25, we have reported EBITDA of rupees 3,030 crores, which is up by 19.8% year-on-year basis, with the EBITDA margin of 24.8% as compared to 24.6% for financial year 2024. However, if we adjust the EBITDA margin with non-recurring expenses, especially related to BSV transaction, our adjusted EBITDA margins for FY25 has increased to 25.9% as compared to 24.6% in FY24, which is at the higher end of our guidance of 25% to 26%. This increase in adjusted EBITDA margin by 130 basis points is due to increase in gross margin by 260 basis points, and a part of it has been offset by increase in expenses. The R&D expenses for the quarter was rupees 87 crores, which is 2.8% of the sales, and for the full year 2025, it is 2.2% of the sales, which is in line with our guidance of 2 to 2.5%. The finance cost for Q4 FY25 has decreased to rupees 191 crores from rupees 221 crores in Q3 FY25, which is driven by a repayment of rupees 3,000 crores worth of commercial papers in January 2025. In Q4 FY25, the depreciation and amortization expenses have increased to rupees 231 crores as compared to rupees 100 crores in Q4 FY24. This includes 110 crores of amortization impact related to BSV assets. And if we look at for the full year, the depreciation and amortization expenses has increased to rupees 621 crores versus rupees 378 crores in FY24, which is primarily due to amortization impact of rupees 194 crores on BSV assets. The effective tax rate for Q4 FY25 was at 16.8% as compared to 16.6% ETR in Q4 FY24. However, the ETR for the full year FY25 is 20.3% as compared to 19.1% last year. The ETR for the current quarter is low because of the lower tax on sale of Mahananda Resource and Private Limited, which is a long-term capital gain tax. The ETR for the full year has increased on account of certain disallowances of expenses, primarily acquisition-related, as well as a higher ETR of BSV. Accordingly, we continue to maintain guidance of 21% to 22% for the next year. The profit after tax for Q4 FY25 decreased by 10% to rupees 429 crores on account of higher finance cost and depreciation costs pursuant to full quarter consolidation of BSV with diluted EPS of rupees 10.3 per share of rupees 1 paid. The cash EPS, which is the EPS adjusted for non-cash items like depreciation and amortization, was at rupees 15.9. For the full year FY25, PAT increased marginally by 3.4% to rupees 2007 crores from rupees 1941 crores last year. The diluted EPS and cash EPS for FY25 were rupees 49.1 and rupees 64.4 respectively. The net operating working capital days for the quarter has decreased to 50 days as compared to 52 days in Q3 FY25. However, as compared to FY24, it has increased by 8 days to 50 days from 42 days in FY24. Further, in FY25, our cash flow generated from operations was at rupees 2,413 crores, which is on an year-on-year basis an increase of 12.1% from FY24. Our capex spend in FY25 increased to rupees 531 crores, remaining at 4.3% of the total revenue, which is in line with our guidance of 4 to 5% of revenue. As a part of our financial prudent approach, we continue to strengthen our balance sheet and have reduced our net debt to rupees 5,784 crores as of 31st March 2025, and this has been aided by monetization of non-core assets. And this has resulted in improving our net debt to adjusted EBITDA ratio to 1.8x in FY25, which is in line with our guidance of less than 2x. With that, we conclude our remarks and welcome any questions which you may have. And I now hand over to Abhishek.
So, thank you, Ashutosh. So now,
Ashutosh,
we can start the Q&A, please.
Sure, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touch-tone telephone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. I would like to remind the participants, if you wish to ask any questions, you may press star and 1. We have our first question from the line of Kunal Dhamesha from Macquarie. Please go ahead.
Hi, good evening and thank you for the opportunity. One for Rajeev ji on the BSV portfolio. Now that we have this portfolio for close to 6 months now, how has the performance been, especially in Q4? Let's say on a year-on-year basis, if we look at the revenue for BSV, how has that progressed? And what is the outlook there on the BSV business? Our domestic revenue growth guidance is 1.2 times IP, but specifically on the BSV portfolio, how does the outlook there? And then what is the synergies that we are expecting? Earlier, we had guided for 50 to 100 crore synergies in 12 to 24 months. So when should we start seeing that? And the integration cost, is it just for this quarter, or do we expect that to continue?
Thank you, Kunal. In the month of October, we took this organization, and naturally, when you take such an organization, it takes time to really settle in, bringing best of the leadership, whatever changes one is supposed to bring. That we have done it. And if you just look at the BSV is a fantastic kind of organization, and we were just looking for an organization which has high entry value products that we have acquired. Going forward, next year we expect the growth would be in the range of 18 to 20%. This is the kind of the growth we expect. And what was next? Any other questions here from your side?
Yeah, so on the synergy side, we had said that it would be 50 to 100 crore in 12 to 24 months. So how are we tracking on that target, and what should we expect in FY26 on that?
We said that it will take, the synergy will take 12 to 18 months, 12 to 24 months. That is how BSV have taken. When we acquired BSV came to us with TTK products, prescription brands, which we have taken in Mankind, because for that, Delhi Mankind is an appropriate company. On the second side, actual BSV, original BSV is super specialty, very high entry barrier product that is over there. So whatever corrections we were supposed to make, we have made, and whatever changes we wanted to bring in that TTK brand, that particular division, we have done that. Optimization, commercial excellence, whatever changes we wanted to bring, we just wanted to close everything in the month of March before the next year starts. So now on this, things will be better in next 12 months time to 18 months time, you'll see the synergy. We promise that will definitely happen.
Yeah, if I can add just some data points, like for example, what Rajeev ji said that, the TTK RX business shifted to Mankind operating model. So they were running, the small business was run into 3 divisions. Now we have converted into 1 division. It had more than 600 people. So as on March 25, it had 440, and as we speak, there's another optimization that has happened. And there's also a lot of emphasis on portfolio optimization. So some tail brands, we have kept some focus brands. So this is as far as TTK RX business is concerned. On the WH specialty business and domestic side, we have strengthened leadership. The top CEO, the India head has come from one of the top companies in the India pharma space. There the focus is largely on improving the operational efficiency. We believe there's a lot of juice left in terms of improving, doctor connectivity, institutional penetration, improving MR productivity. So that process is on, and we will soon see some, recovery in that space.
In the month of April only, we are finding very good traction of this TTK brand, BSV TTK brand, because certain brands are so iconic. The moment some kind of a connection was there with the customer doctors, immediately the response started coming. Osopan and Lactair. These are certain brands. They basically were there in the market, and some kind of push was required. And we gave that, and the first month, or I'll say a few 2-3 months response is fantastic.
And just to reflect on your last question, yes, Pranav.
Yeah, please go ahead.
So your question was with regard to the integration cost. So Q3 was driven by the acquisition cost. Q4 has been integration cost, basically to bring in effect the change of control which has taken place, and certain consultant costs which has been there, all put together has been 25 CR or so, which we have called out. And once we will start the legal integration process, so then there will be certain regulatory costs which will be associated with that. Yeah.
Okay. Yeah. And the second question on the EBITDA margin guidance of 25 to 26%, which seems more or less kind of, flat, if I look at the adjusted EBITDA margin of around 25.9%, right? So, wouldn't there be, let's say, BSV grows at 18-20%, and our domestic business also grows at 1.2 times. Shouldn't there be more operating leverage? There'll be synergies, from this, because we already started optimizing the, manpower cost at TTK or BSV, right? So, what are the drags? One is, I think, R&D expense, which we are expecting at midpoint, 50 basis point higher. But anything else that on the drag side that, I'm missing?
We mentioned in the last call as well that in last couple of quarters we have done a lot of common reforms in Mankind. Once upon a time, Mankind was a kind of a company which was bottom up. Everything was bottom up. Nothing was top down. So different divisions were working as per their best practices. There comes a time, after a few learnings, we brought a lot of new leadership at the head office level so that the policy should be uniform. All 28 divisions should work in one direction. There should be proper synergy, because in the absence of synergy, a lot of wastage happens. So, and we mentioned in the last call as well the kind of steps we have taken. Very less companies are there in India who can really have such a courage to take actions. A lot of, I would say, commercial excellence, a lot of changes, a lot of improvements, a lot of training, a lot of replacements. Every sort of thing has been done in last 1 year time, and we try to do everything before March, last year March, so that this year should start with flying colors. Flying colors in the sense that on one side, actual results which we hope, which we expect in Mankind would come slowly and gradually. After this first quarter, we feel that whatever replacement we brought after changing a lot of people will start giving us right kind of synergy and right kind of response second quarter onwards. But as a whole, whatever we are saying right now, that at the end of the year, whatever projections we have given, will be meeting those. But yes, we have really worked hard to make Mankind strong foundation, because it really happens in every organization. Organization keeps growing, and then comes a plateau. And if you are courageous enough to really see that what are the drags, can you replace them, can you change them? There are two ways. One way basically is what? Do it slowly and gradually. And the second basically is what? Once you find out that something is wrong, something is not right, instead of doing it next year or next year and dividing that into many, many parts, we thought of doing everything in one go. And we feel that everything has been done last year. Now, things will be better, much better.
Sure, sir. Thank you and all the best.
Thank you. We have our next question from the line of Tushar Manudhane from Motilal Oswal Financial Services. Please go ahead.
Yeah, thanks for the opportunity. Sir, just to start with, if you could share BSV sales for the quarter, domestic as well as exports.
So we have not called out specifically. I think Sheetalji gave, the organic numbers. You can call out the same. What I can add is that mandate brands, which is our key focus area. So the domestic mandate brands for the year has grown at 10% plus. and international specialty managed brand has grown at 18% plus for the year. IVF as a category for the quarter has grown at 20%, and for the year has grown at 26%. I think this is the broad color we are giving, and the numbers you can calculate by just doing the organic numbers.
Got it. So secondly, while the chronic, we are greatly positioned to grow 1.2 times, but given that we still have considerable portion of acute therapies as well, so how to think about the overall portfolio growth? So ex-BSV, the prescription business.
So chronic currently, I mean, if you see, continue to grow 1.2x to 1.3x, which is largely the cardiac and the diabetes. Our core five focus area apart from cardiac and diabetes is gastro, gynae and anti-infective. And we also hope to improve on the respiratory as well as derms and vitamins.
Yeah, so how to think on the growth plan if we sum up, across the therapies for the acute side?
So acute side, with the kind of restructuring and initiatives that we have taken, so in the last 2 quarters, we have seen, some corrections, and it is largely in the acute side. It has also impacted some of the, acute segments, and we expect the growth to start from Q2 as Rajeev ji mentioned.
And if you could also lastly share, sorry.
Yeah, just to add to what he said, I think if you see in acute growth in quarter 4, we had to consider the regulatory impact of 1172 in acute portfolio. If you consider that, we are at par with the market. And going forward, as you rightly said, that we are expecting that acute portfolio will also grow at the same pace what market will grow. And chronic, as usual, like we will be stronger in chronic. And some of the portfolio, what is said strategically, we are focusing on, especially gynae. You have seen that post BSV, we have strengthened our gynae portfolio, and there is a significant jump in market share overall. And gastro, of course, it has been a major focus for us, and going forward also, it will be a major strength along with our cardio and diabetes segment.
Got you, sir. Just one more, if I may, that the consumer health has recovered, considerably in FY25 with almost 15% growth. How to think about, whether the sort of this is the kind of sustainable growth to think about in consumer healthcare, or there is still, some more steam left as far as growth is concerned in this segment?
We feel that this is not basically flash in the pan. This kind of a growth will always be there. We are very, very bullish about our consumer healthcare business. And whatever branch opportunity we have launched in last couple of, I'll say, quarters are also getting good traction. We mentioned you the name of Nimulid. We mentioned you that our news. And our Gastrofast is doing fantastic. Very, very good. And where we were weak in the past, we were weak in e-commerce, we were weak in modern trade. Even there, a lot of good performance is happening. We feel that this year, next year, going forward, our consumer business will be doing fantastic.
Thank you, sir. Thank you, sir. That's it from me.
Thank you. We have our next question from the line of Neha Manpuria from Bank of America. Please go ahead.
Yeah, thanks for taking my question. First question on BSV. While I understand we are not giving specific BSV numbers, I think at the time of the acquisition, we had mentioned about the scope of margin expansion to 30% and higher on BSV over the next 2 years. Based on your, what you've seen so far and the reforms that you have put out in BSV, the changes you've brought forward, is there still, visibility on getting to improving margins within the BSV portfolio? And specifically on BSV on international, I think if I were to calculate the numbers, there's been moderation in international. So if I were to think about the 18-20% growth, how much of that would be domestic versus international? Given what's happened in fiscal 25?
Yeah, thank you for your question, Neha. So, international growth has been very strong, upwards of 20%. We are not giving specific numbers. So, domestic has been a bit muted because of some of the corrective action we had to take, especially in the TTK RS business, which has seen a sharp drop, which is from April onwards, as Rajeev mentioned, the growth has started. So, we are positive on that. On the WH specialty also, while mandate brands have grown, but some impact is there on the tail brands. That's why the growth is a bit muted. As far as margins grow, we remain very positive. Current margins are in the region of 26 to 27%, and we remain committed to improve the margin profile by 50 to 100 basis points every year. 30% probably will reach in the next, by fiscal 30 for sure, because it needs some R&D investments also. As the portfolio and the pipeline, there are a lot of very good opportunities, so that would require some investment. So that's why there will be a bridge from 26, 27 to 30, but we are very positive. Thank you.
Understood. And the R&D investment, if I were to think about it from a consolidated perspective, is the current quarter run rate something that I should build the increase upon? If you can give some guidance on what the total R&D spend would be?
Yeah, so guidance is 2.5 to 3. You can take an average of the two.
Okay. So, not too much change. Got it. In the core, in the existing Mankind domestic business, we've mentioned that growth would come back from second quarter onwards. Is there any risk that you see, in terms of the MR that you've added or that you've refreshed not being able to ramp up? Is there any plan to again, add more MRs as we think about the next year to, grow that, to deliver that higher than market growth? Just some color there.
Neha, there's always some kind of a risk in everything you do, actually. So we are talking about we are increasing the medical reps and managers. What we have done in last couple of quarters, we have replaced medical reps, managers, field force as a whole. A good quantity of that. Wherever we found that inefficiencies were there, right practices were not there, and whatever, I would say, not right things were there, we were very blunt and straightforward in making correction immediately. As Mankind has always been very, very fast in executing things. One way is that you look at your balance sheet, you look at your other things. On the second side, we have always believed that if inside things are right, foundation is strong, things will move very fast. In my own career, I've seen in last couple of years, many years, that sometimes in the greed of growth and profits, right culture evaporates. So we are not that kind of a company. Whatever actions we were supposed to take, we have taken those drastic actions. These were not simple actions, these were drastic actions. We have done that, and we've done and dusted. And now, when I say that this new medical reps and new managers have come, they will take some time. They have taken some time. It's not that everything has happened in March or everything happened in December. Everything happened gradually, and we decided that by the end of March, we'll close down everything. And we have done that. So that's one reason we are saying that maybe first quarter, it will take onwards. As we mentioned that whatever growth we have projected, whatever numbers we have given, that will be done. We are very sure about that.
Understood. And so the MR count still remains at about the 16,500 level that it was in the last quarter.
Absolutely. We are not increasing. We are basically replaced, improved, trained, brought new energy in our field.
The only small addition is, adding on some experienced talent pool.
Correct.
In, being cluster heads, that's handful though. So cluster heads, some of the national sales heads from outside. So when he said bottoms up in the past, it's, given the scale and size, you need to do some top-down strategy of hiring some, experienced people and, upgrading your talent pool as per the size of the company.
If I just say that in last year, overall, servicing of Mankind have been done. Deep down cleaning have been done in Mankind in every aspect. And we are very sure about it. Whatever in future will happen very, very soon.
And here, this 16,500 includes manager also. This is not only.
Yeah. Yes. Thank you so much.
Thank you. A reminder to all participants, if you wish to ask any questions, you may press star and one. Anyone who wishes to ask a question, you may press star and one. We have our next question from the line of Chintan from Giri Capital. Please go ahead.
Thank you for the opportunity. Hope I'm audible.
Yes, Chintan.
Yeah, thank you. The first question is on the other OpEx. You highlighted a couple of things which bumped up.
Your voice is not that clear. Can you speak up?
Chintan,
is it audible now?
Yes.
Is it audible now? Is it clear now?
Bit better.
Yeah, thanks. Sorry. I was asking on the other OpEx, which came up significantly higher, around 26% of sales. You mentioned a couple of pointers around the investments on the new launches plus R&D expense as well as the integration cost. How should one look at other OpEx going forward as a run rate basis? That's one. And second is on the debt side. We did mention that we are targeting some repayments and all. How should we look at FY26 repayments given that the cash flows continue to be very strong for us?
Sure. So let me start with the latter one. With regard to the debt portion, so what we are targeting is that by end of FY26, we should have the EBITDA to debt ratio of close to 1.1, anywhere between 1 to 1.2x of the EBITDA. So that's the guidance on which we are working. And as we highlighted earlier, that by FY28, the target is to retire all the complete acquisition-related debt. And with regard to the other expenses, so this is in this quarter, there has been a bulge on the other expenses, and for the next year, we have maintained the guidance of 25 to 26%. So from there, you can draw that. That applies to all the expenses, not only to the other expenses. Yeah.
Okay. And on the acute side, if I come, on the acute side, we did some restructuring. We are now done and dusted with. How should one look at acute growing from here on, given the base for this year has been a little bit softer due to the internal restructuring? Should we expect, we mentioned 1.2 times IPM is our target for growth next year. Specifically for acute, if you can highlight some bit, what are we doing over there to drive the growth?
So, hi, Chintan. I think we have spoken about this before. So, acute has been a little soft in Q4 for most of the acute giants or acute heavy companies. We are also no exceptions to this. But yes, there are certain impacts of regulatory phenomenon which are there in unwanted 72, which I have spoken already. But in future, as I said, we have been focusing on gastro, gynae, which has been our major forte in acute and anti-infective as well. And what we are expecting is we would be at par with acute if we talk about annual growth. So I think what Sir has already spoken about, that a lot of restructuring has happened from different paths and at different levels from field to HO, and those impacts should be visible in acute as well.
Got it. And exports, any guidance?
Pardon?
Sorry, on exports, any guidance?
So for Mankind exports, we are expecting single digits. And from the BSV side, we continue to maintain that the growth for the overall company BSV, I think guidance given is 18 to 20%. International growth will be higher than 20%.
So on the overall sales mix standpoint, so export will be less than 15% of the overall sales in the next year. So 85% plus will be domestic, export will be 15%, less than 15%.
Got it. Thank you, and all the very best.
Thank you. A reminder to all participants, if you wish to ask a question, you may press star and one. We have our next question from the line of Rahul Jiani from IIFL. Please go ahead.
Thanks for taking my question, sir. Just a clarification on this 1.2 times the IPM growth. That you mean for the prescription business excluding the consumer healthcare portfolio?
Yes, correct.
Yes, Rahul. Okay. Sure, sir. And this growth bounce back which you are expecting from quarter two, so are you seeing fundamentally things improving in the acute segment, or this growth bounce back from 2Q would largely be a function of the fact that the restructuring of a mass market business would be in the base quarter of last year, and that restructuring in the base would then help us to drive improved growth from 2Q?
Rahul, just giving some color on the last year performance, this is fiscal 25. If you see quarter 4, we have grown 10% in the domestic business without OTC, which is already 1.2 to 1.3x the secondary growth by IPR. And for the full year, we have grown at 9% primary versus IPR growth of 8.5. So we are already outperforming. And what we are saying is, from Q2, the growth will be even higher. So 1.2x, I mean, if the market is growing at 10%, we are expecting our growth to be around 12% plus. So that should not be a tall task, right? Especially when we've taken so much of initiatives. And this year also we have outperformed IPM. And what I think what Sudipto said was on the, there is also, if we add back some of the, regulatory headwinds, there's another 50 bits that we need to add back. So the year performance is already 1.2x and we expect that to continue at 1.2x.
Okay, so the organic growth which you called out was for the prescription business excluding the consumer healthcare portfolio?
Right, Rahul. Thank you.
Yeah, okay. Thank you.
Thank you. A reminder to all participants, if you wish to ask any questions, you may press star and 1. Anyone who wishes to ask a question, you may press star and 1 now. We have our next question from the line of Siddharth Negandhi from CWC. Please go ahead.
Hi, thanks for the question. Thanks for the opportunity. On basis the revenue guidance on the domestic business, the exports business and the consumer healthcare business, considering the consumer healthcare business is likely to grow fastest, will that be a drag on margins, or are the EBITDA margins of the consumer healthcare business in line with the domestic business? And similarly on the gross margins, how do you see that playing out, considering the consumer healthcare business is going to grow fastest?
So for the consumer business, we have, so those EBITDA margins, they are part of the investor pack, so they are in high teens, close to 20%. And overall company margin is in the range of 25 to 26, so that's the guidance we have given. So the consumer business margin currently is at a lower rate as compared to the company average. But it's a matter of scale. Once the business gets scaled up, then definitely it is going to inch up to the company average in the near future.
And size of the business of OTC is around 7%, so it's not contribute or significantly, you can say, dilute the overall margin.
And moreover, as Sheetal ji has highlighted, we are maintaining the same guidance, 25 to 26% for the EBITDA margin on overall basis.
The second question was on gross.
So gross margin, that is also in proportion to the EBITDA margins for the consumer business.
Clear.
So gross margin is comparable to the acute gross margin, you can say. Lower than the chronic, but comparable to the acute margins.
Clear. Sir, on the acute piece, just want to understand, considering the impact that trade generics seem to be having, especially on the acute side outside of the metros, what is our plan on launching our own trade generics or taking action to sort of prevent that growth of trade generics impacting our growth?
See, I mean, this trade generic is there in the business in the last couple of years. It is not only in smaller cities or bigger cities, in metros. Everywhere trade generic is there. The impact is already there. I mean, these kind of challenges are always there. But please understand, whenever somebody buys a trade generic, the chemist gives him the medicine. Patient does not get that medicine at an economical price. It's like, I mean, earlier people used to go to chemist without the prescription. Doctor used to give our medicines. Now no more. I mean, just imagine hypothetically, if trade generic would not have been there, the growth of this pharma market would have been more than 16-17%. The impact of trade generic, whatever you see the growth, it is keeping trade generic in mind. So that even in trade generic side, if you just look at the data, it has slowed down. The growth has come down. The kind of growth it was having in the past, it is no more now. Because ultimately, doctor's prescription really matters.
Sure. Clear, sir. And on the pipeline, you mentioned about a clinical trial happening for an obesity drug in Mankind. Any guidance on further launches in Mankind and separately in BSV?
No, so this is GPR 119 you're talking about, anti-obesity drug?
Yes, that you've already mentioned about the fact that it's entered phase 2 trials. But any other notable inclusions in that pipeline, both from a erstwhile BSV and Mankind side?
So in the investor deck, if you go through, we have given one BSV at a glance. There we have given some color on the pipeline, which is on the biosimilar products, as well as some of the innovator products, which is in the AMR space and anti-thymocyte space.
Got it. And on the Mankind, any more drugs in the pipeline, innovator drugs?
So this is what we can talk about at the moment, GPR. There could be couple, but would be very initial stages.
Got it. Thank you.
Thank you. A reminder to all participants, if you wish to ask any question, you may press star and 1.
Yeah, I think we can call it off. I think the time is up, so decide.
Sure, sir. As there are no further questions, I would now like to hand the conference over to the management for closing comments.
Thank you. Thank you for any further queries or clarification, request you to please write to us on investor.relation@mankindpharma.com. Thank you and have a nice day.
Thank you. On behalf of Mankind Pharma Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your line.